Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us some of the big names are starting to show weakness, while some AI-related juniors are picking up. He takes a look at gold, the U.S. and Canadian dollars, and copper. President of Venable Park Investment Council Incorporated, Danielle Park, believes rising interest rates might be tough to swallow, but are necessary to weed out the weak links in the economy. She tells us personal debt bubbles, especially in Canada, are already beyond dangerous. Publisher of the VRTrader.com newsletters, Mark Leibovit, tells us about the correlation between lunar cycles and the markets. He comments on why China is on a gold buying spree and whether digital currencies are a good idea. He also has a special offer for our listeners. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
How did the stock markets do this week?
Well, this was the rollover week. You know, July was that month where we had lots of excesses on the upside. And then slowly some of the big names started to settle back and lose their momentum. And there's some real juniors out there that in the IA and the EV area, the AI and EV, ended up taking over the leadership that had some just exponential moves. But then again, that's what you tend to see at the tail end of these big moves. So as of this week, a lot of things have come off pretty significantly. Some of the big names, Microsoft, NVIDIA, down on the week. The Qs, the NASDAQ 100, had a poor week. And, this was the beginning of the seasonal downtrend that you typically would look for the quiet period leading into September, October, where you get your better opportunities. So at this point, it doesn't look as though, we're down to levels that should provide lasting support. Typically, after these big runs, in things like the S&P or the NASDAQ, you'll come back and hit the 20-week or the 50-week moving averages. And in that case, we're looking at probably another 5% below here before you really start to think about supports as far as the general indices are concerned. Have been some of the high flyers have come down hard enough to get decent bounces, but as I say, in general, the indices look heavy. There has been rotation. There's no question about that. If we take a look at some of the staples have started to come back quite well. And energy markets, here we are. We got crude oil up at $83, having been down in the low 70s not all that long ago. And, as we mentioned here a week or so ago, crude has had a decline as it has a year or more. What you base out, the first part of the rally is typically going to be 9 weeks or better. We are just finishing the 6th week at this point, so thinking that we've got a few more weeks in this rally before you get a decent pullback. And on that basis, the oil service companies and ETFs like the XLE and the XCG have still probably got more room on the upside.
What's happening with gold and silver?
They are right into a time window for our work that should be producing a low. We've been doing the correlation with some of these other historic resistance levels. Here we are. We've had trouble at this $20.50 to $2100 level on gold, similar to what we saw back in 2009 when we were at $1,000. Similar back in the 1978, 79, trying to get to 400. And this consolidation phase that we are in is just about ready to, I think, conclude itself as far as the bullion is concerned. The resistance, without a doubt, is still pretty heavy above us. I think the key item right now is the U.S. dollar index. Dollar has been very buoyant the last little while. We got the U.S. dollar closing the week off at 102.80, and that was the new high for the week. Actually, I think it's the highest high that we've had in about 4 or 5 weeks. And if the dollar is going to maintain this buoyancy, it's going to be hard for the precious metals to really get up and put much on the upside. So from a technical perspective, the dollar index, you want to keep an eye on that. Probably the 101.70 level, which was the lows of the last 7 or 8 days, that's a pretty critical support area. So if that gets taken out, I would be looking to be fairly aggressive here as far as the gold and silver are concerned on the upside, and think that you could get a fairly conservative move. But it's going to take the decline in the dollar to really be the catalyst point to get these metals going right now.
How is the U.S. dollar and Canadian dollar doing?
Well, the Canadian dollar moving along pretty much with other currencies here. Been easing down. Closed off the week at the 74 1/3, 74.33. It was a shame that it tried to have that breakout and hold around 75, but couldn't do it at this point. Pretty disheartening, especially with what we've seen in terms of the oil market with all that buoyancy out there. So it's, from a perspective of looking at cycles, we're probably into a short-term cycle low here for the Canadian. I think we could probably get a bounce back towards the 75 range, but wouldn't be too excited about too much on the upside at this point.
On the anything else file, is there something we should be looking closely at right now?
Well, the one that has been interesting the last few months has been the copper market. We take a look at it. It had a hard break last year and then had a classic Fibonacci retracement rally, 62% rally up to the $4 range in January. And now it's settled back down to 70, to the 372 level. This is just formed itself into a very nice symmetrical triangle. Problem is that it's got a very highly bias to it. And if we start to take out that support around the 370, you're probably looking at 3.25 or under for copper prices. That then would fit in with a weaker stock market, weaker economy through the next few months. So I'd be pretty cautious about the base metal complex, and you might want to be taking a look at some short sale opportunities as far as copper is concerned.
Ross, thank you so much for chatting with us.
Good to be with you, Jan.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at Charts by Ross. Coming up, Danielle Park next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites jugglingdynamite.com and venablepark.com. Danielle, welcome back to This Week in Money.
Hey, thank you, Jim.
The Dow is close to new highs. Some are saying it's climbing a wall of worry on its way to the new highs. Your thoughts on that?
Yep, so it's about 2% from its prior peak in December of 21. So I guess that's another way of saying it's gone nowhere for just over 18 months. But it is pretty typical of bear markets to have this kind of a big reflex rally. And I'm still not convinced that this isn't what we're witnessing this time. For sure, we had a lot of short interest built up in the market at the end of 22 because of all the negative price action that happened in that calendar year. And we came into the 2023 with, because of the losses, most people's sentiment moves in direct relationship to the price movement. So when you've had a very negative year, you get people being very bearish. But then, once everyone's sort of gone very short on the equity side, you see them start having to buy back and that buying back pushes up the price itself, and then you get these euphoric rallies. And the institutional side can track all that to say, oh, I see that the short contracts are being covered here. But the retail crowd, of course, typically just gets sucked back in, thinking all is clear, and the mainstream commentators and sell-side firms and the bank economists and all those people are always telling everyone that all is clear and you shouldn't have to worry. So, of course, that's typically what happens. You get this bifurcation of the so-called smart money, moving more to the sidelines, taking the opportunity of the rally to sell more, de-risk more, and you get the poor retail crowd pushing more of their shekels in, right? In the hope that the losses are behind us, so to speak. So I think that's what we've seen year to date, and it's quite noteworthy that, the Dow and the NASDAQ and the S&P are the ones that are the most weighted, of course, in these large tech companies, which, as we've discussed before, whether you're talking about the top 5 or the top 10, they're primarily been heavily influenced by this belief that AI is coming and AI is changing the world. And so you've seen huge multiple expansion, both in terms of price and sales. As you've had a downtrend in earnings, quite a significant earnings recession over the past year, and yet these stocks have been going up again on some kind of belief that this time is different and AI changes everything and has, averted the business cycle, which of course I don't think any of that is true. But when you look at the more, real economy, Main Street stuff, which is sort of reflected in the smaller medium cap companies that are not so in the AI space, but just in the meat and potatoes, so to speak, of demand and supply in the economy. You see things like the Russell 2000, Jim, is still more about 20% below its November 21 peak. So it's rallied back later in the last couple of months as well, but nowhere near the peak that it reached. And I think that was still the cycle top for it in November of 21. And same with the NASDAQ. It's remarkable. The NASDAQ 100, even though it's had this huge concentration in these big 7 tech companies, which have, blown the doors off, the NASDAQ itself is still off 15% from the peak. And the TSX, of course, is down still about 7%. Now, we've had a big rally in the oil price and natural gas price, and that's influenced some of the price action in the Toronto Stock Exchange. But when you look at it again, financials are still way off their peak, and we're just heading into this credit cycle, the down cycle for credit, which, of course, with the Canadian market being 32% in financials, what happens in the banks and the credit cycle is really a huge determinant of what ends up happening to our stock prices in the course of this. So all that to say that it's common to see these kind of, really impressive rallies in bear markets, but I still think that the peak was in late 21, early 22, and that the trend remains down from here.
The Bank of Canada meets again on September 6th. What do you think they're going to do with interest rates?
Well, I have to say that I have no idea what they're going to do. I have to say they've surprised the hell out of me in the last, 16 months following the U.S. Fed in the most rapid rate hiking cycle since 1980. And but I think that what they should do is pause. I think that they've done enough. I didn't think they'd do it this quickly. I didn't think they'd have the courage, but inflation gave them the cover to do that. I've said this before. I'm actually grateful rates have normalized now. I didn't think it would happen that fast, but I'm really happy that it has, because we had to get to this clearing and cleaning out phase, and we've arrived here quicker than I thought we would. So I think the bond market thinks that the Bank of Canada should be done. I mean, the 10-year Canada yield peaked in October of 2022, and it has not made a new high since. So that's really to say that we've seen some the price of Treasury or government bonds rallying in the last little while. That means that it's pulling the yields on those bonds down, which ultimately impacts mortgage rates. So mortgage rates, should come off a little as the bond market rallies and you see the Treasury yields come down. But that would suggest that the Bank of Canada has done enough already to really trigger a major downturn in the economy, an increase in unemployment, which is in fact the target here after all. In June of last year, we were at a 52-year low in unemployment in Canada. So the problem was that we were having excess demand in the economy, both because we had high employment, but also because of all the credit and the zero rates and all the behaviors that have been adopted in the prior 12 years of constantly, pushing down the rate, the cost of money. So, all that to say, we've got this monster bubble in Canadian home prices thanks to that 12 years of ultra low interest rates. And housing inflation is actually the largest part of the CPI basket. So the rock and the hard place for central banks here is that they've done enough, I think, in terms of if they just sit on the sidelines here, they're going to watch the business cycle fulfill its destiny in a recession, a contraction in economic output, as well as an increase in unemployment. Typically, a year into a recession, you're going to see an increase of 1 to 1.5% in the unemployment rate, and that's in fact the base case forecast that both the Canadian and the U.S. central banks have. So we're going to see this. Whether they do anything more. The other thing here is that with the rate of inflation declining, and we got the latest read out of the U.S. this morning for July, 3.2% annualized rate. So the from 9% last June, the change in inflation has been moderating quite significally. And the fact of the matter is that even if they don't raise rates further, as the CPI comes down, real rates are rising, right? So if you keep the overnight rate at 5 or 5.25 or 5.5, and the CPI or the cost of goods and inflation comes down, your real rate is even higher without even moving further. So I think the only problem here is that we still have a lot of froth in the housing market, and that is a killer. And it's directly related to all the excess debt that's in the economy and all the unproductive activities that have been going on in the economy. So I think on the one hand, the central banks have done enough in terms of triggering the recession and the disinflationary impulse that they need to. The two problems with that being that if they continue to see froth and speculation going on in housing, that's an issue because that's 30% of the CPI, and that has to come down. So they're kind of probably going to keep talking tough. They may just say they're pausing just this time. They're not going to give any proclamation of all clear because they are worried about inflation coming back. And then again, we've had this spike in the, cost of oil and gas just in the last month that feeds back into that loop, right? So the pressure again starting to build, and we've had some wage settlements and some negotiations and union agreements in the last little while that are pushing up on the cost of wages. So that all, are percolating. Housing and wage increases are a concern for the central banks that may keep them, if not saying that they're pausing, maybe saying they're going to skip a meeting or two here just to see how the dust settles. Jackson Hole is this month, of course, closer to the end of August, and it's quite possible that Powell may drop some bomb there. But I think they're going to continue to carry a big talk, so to speak, at least, trying to convince the equity and housing and other asset markets that it's not back to, the speculative mania that they've been very amenable to in the last few years. I think they're trying to crush that impulse so that we can get some of that froth back out of asset markets and help bring the cost of living down and reboot the economy. So all that to say, I think they're more likely to skip. I think they're very near the end of their tightening. And if they do go further, it'll be because of their concern about the housing market still being way too elevated and them needing to bring that down.
What percentage of people in Canada have no debt?
Well, the Financial Consumer Agency of Canada actually, their latest report suggests that as of 2022, about 30% of Canadian households reported as debt-free. So at least 2/3 are indebted, and mortgages make up the greatest share of that debt. Just about 41% of Canadians rent, and 72% of recent immigrants rent. So that just shows you that that rental number has actually increased in the past couple of years, where again the price of housing just became so unaffordable and remains so unaffordable that people that do the math and have any ability to just rent something have been more inclined to take that option than to try and buy. 77% of Canadian homeowners have a mortgage, and that's risen over the past few years as well. There used to be fewer people that had mortgages, and again, mortgages were more commonly paid off by the time people were, by the time they were 50 for sure. The age group under 55 has the most amount of debt in Canada, which is understandable. They also happen to be the drivers of consumption in the economy, though, with peak consumption coming about 55. So if the younger people are incredibly indebted, that's a negative for momentum in the whole economy, and that is a problem that we're seeing in all the latest data. 2/3 of households report having trouble meeting their commitments. Now, that compares to about 57% in 2020, so that's a shockingly high number, 2/3 saying that they're having a hard time just meeting their basic payments, and 63% of homeowners with a mortgage say they are now financially stressed, and that's compared to about 59% for renters. So you can see that this cost of inflation in housing is a major problem, and that's what I was referring to earlier, is central banks don't go to, if they want to keep the pressure on bursting that bubble, that's what I think will keep them from either saying that they've hiked enough, but certainly from preventing them from going to cutting anytime soon. I think that the tendency to cut interest rates is going to be delayed this time by this concern around the mess in the unaffordable housing. So the other way to look at that is that consumer debt in Canada just passed about $3 trillion, which is a huge number. It's above 88% of disposable household income, which is a world-leading stat in the worst kind of way. We are of the G7 countries, we are the highest, the most indebted in our households, which is a terrible thing. Household debt as a percentage of our national GDP is above 105%. That's what I was saying is the highest of all G7 nations. So it just means all that really says that we are, and don't get me wrong, the U.S. Consumer credit information right now just hit an all-time high on every category: mortgages, auto loans, student loans, which of course the payments are resuming October 1st at this point, and they've been in a hiatus, and data shows that the people that were on the brakes from the student debt where they had the moratorium for the past few years, they, instead of trying to save or pay down debt, they actually took on more debt because they thought they weren't going to have to pay that student loans back. So the U.S. is in bad shape as well, but Canada is just that much worse than them. And It means, for example, in the 2006-7 downturn, the U.S. was we're actually worse than they were in terms of household debt at the peak, but that's what made the housing downturn so much worse in America than in Canada in 2007-8. We came into that downturn with relatively less hype in our housing market, much lower household debt, and so we had more resilience to ride through the Great Recession in that cycle. The same actually in the 2000 cycle, where the tech mania was really concentrated primarily in the United States and had spillover effects to the U.S. Property prices in certain areas as well. And Canada really had been flat since the 1990 slowdown and recession. Our housing market really didn't recover after the 1990 recession. It was sort of like flatlined. And so that meant that when we came to the 2000 downturn, we didn't have as much froth or excess to wipe out there, and we were relatively more stable. Unfortunately, it's the opposite today, right? We're coming into this one the least prepared we've been, and we've got interest rates now at 22-year highs, which is really something. But at the same time, we have debt at the highest we've ever had. So it's not so much a problem of interest rates being, so high historically. They're more normal right now historically. It's a function of the fact that people took on so much debt at the much lower rates that were artificially suppressed for so long, and that's really left us extremely vulnerable. The fact of the matter is that we're seeing a lot of people who are putting their homes on the market now because they're saying, we know how many mortgages have been are coming up for renewal on which terms, this year, next year, the year after. So we can literally see that data. And it's billions and billions of dollars coming up for renewal. And as that happens, some people will just not be able to qualify for a renewal, especially the variable rate mortgage crowd, of which there was an enormous amount coming into this rate hiking cycle, because it was the cheapest rate option for so long there, those people, the ones that kept the payments flat and were just negatively amortizing. In other words, their mortgage has been increasing over the past 16 months rather than decreasing. That's all well and good for a little while, but then when your term comes up and you need to renegotiate a fixed term or a new term, the banks are going to be saying, hey, you need more of a down payment, or you don't qualify based on your household income. That's the reality. And so that's why I'm quite confident we're going to see a pickup in listings.
Are the debt bubbles in Canada becoming dangerous debt bubbles?
I think we're past dangerous. Yeah, I think we're now in the bug hitting the screen kind of mess that comes when you take on too much debt. Every generation kind of learns this the hard way, and I guess that this is the next time we're coming around to this lesson.
As interest rates rise, are people starting to put their money in interest rate bearing products instead of stock market related products?
Well, they should. The sad feature of that is institutions are, the so-called smart money again is seeing, wow, highest rates in 22 years, all the pensions and the insurance companies and places that needed to match liabilities and assets over the past number of years were having increasingly difficult time in the low rate environment. And, they pushed as much as 30% of their assets into these really sketchy, opaque, alternative, private equity, private debt funds, which are haven't yet marked to market in most cases. In other words, their assets are falling, but they don't mark to market regularly, and so they've been keeping this appearance as if they haven't lost money. But in fact, that's coming to an end as well, because there's a finite amount of time you can keep that gig going, and then you finally have to start admitting market prices and selling assets to create liquidity and that sort of thing. So anyway, the institutional side is just delighted that we can now get the best rates in 22 years. And again, no one, it's kind of like we were in such a depressive state for so long where anything that was, the least amount of risk was offering you next to nothing. So people felt they had no option but to buy garbage or to not worry about the price they were paying for anything, just to try and reach for yield. That's always been a recipe for absolute terrible financial decisions, and that's what happened. So now people can make much more risk-adjusted, much more positive returns by purchasing some of these things like the most guaranteed deposits, the government issues, this sort of thing. The trouble is, of course, that the little guy, the retail crowd, is always dealing with the sell side. And the sell side makes all their fees on the equity-based and corporate debt-based products. So they have a huge bias against putting the safest, whether it's GICs or government bonds, that kind of thing, into portfolios. They see that as counter to their narrative of, stocks always go up and, a good time to buy them is whenever you have money, all that sort of thing. So unfortunately, the retail people are always funneled in, and that has happened year to date. We've seen fund flows going from the retail side into the equity stuff, back into the tech concentrated names and that sort of thing. Even though their prospects of reward or returns are the lowest they've been since probably, the peak of 2008 and just before the really bad parts of the bear market. So the risk-adjusted returns offered on the risk side right now are horrific, not attractive. The risk-adjusted returns on the guaranteed stuff is the best we've seen in 22 years. So that should tell people that are doing any sort of paying attention where the capital flows are best placed at this point. But of course, as I say, in the retail side, they never tell anyone to sell anything. They always want people to hold everything and keep buying more risk. Even when they run out of money, they want them to borrow money to buy more risk, regardless of the upside or downside from there. So that's what we're seeing indeed with fund flows, which is too bad.
Should people care about gold and silver?
Well, sure. I mean, to the extent that gold and silver are industrial metals like copper, there's a huge case to be made for their usage going up in key technologies like battery storage, solar panels, wind turbines, electric vehicles, electrifying the grid. There's a huge bullish story there for demand over the next decade and beyond. Now, to the extent that there's always innovation going on and substitution, that's going to continue as well. So I wouldn't say that just because there's a demand for things like, for example, lithium, or there's a certain amount of silver going into these products today, that'll always be the case, because there are, as I say, substitution and new technologies that are reducing our requirement for some of these key staples today. But I would say that as far as financial assets go, that case is a lot less strong. During the 12 years of the low interest rates that we've had, and the highest debt growth in 5,000 years, Jim. So the run-up from 2009 to 22, lowest interest rates and the highest debt growth in 5,000 years. And yet silver bullion is today 47% lower than where it peaked in U.S. dollar terms in 2011. So, you'd think if it was this alternate currency or hedge against inflation or, against the debasement of money and all this sort of thing, which people have beliefs around, you would think you would see some better returns than negative 47% over that period. And really for gold, the price has risen just 10% in the 11 years since July of 2012. So people talk about gains in Canadian dollar terms, but what that really is mostly saying that the U.S. dollar has increased against the loonie. And in fact, it has, right? The U.S. dollar has gone up 36% against the loonie over the last 11 years. That's nearly the entire gain that gold has made in Canadian dollar terms over that time frame. And so, if you could have just sat in the U.S. dollar and had no, storage cost for the bullion, no variability or volatility to speak of. You wouldn't have had to, it's more liquid than putting it into another asset like whether any kind of financial product. If you're keeping it in cash, it's more liquid. So it's more desirable on many fronts, and yet the return was almost identical. So I'm just saying that there's not a huge financial case to be made for it as an investment. Now, people say that they feel more comfortable holding bullion, or if they think if there's going to be a collapse of the financial system, they prefer to hold bullion, and that's all feeling based, and you're never going to talk people out of that. So I think people should do what they think they will feel best at in terms of sleep factor and all that sort of thing. And certainly in 2008, gold did better than equities and corporate debt for sure. I mean, if you look at the chart, actually, the The minors did not. The minors have also been negative. They're still negative 27% since March of 22 with tons of volatility. So again, the companies themselves in that sector are not, tend to be highly volatile, and they're something you can trade, but in my experience, not great for any kind of a buy and hold approach. And if you look at what happened in the 2007-09 cycle, you see that in fact, the mining shares, basically bottomed with everything else into December of 2008. And then you got a breakout from there. So stocks bottomed, 3 months later in March. And from that sort of, end of the recessionary period was coming to a close, and you had, a breakout then in things like gold in Canadian dollar terms. Again, Canadian dollar rallies typically near the bottom of bear markets when you get into the market starts to see the recovery coming and some commodity demand picking up, which has typically been very depressed during recessions. So I guess I'm saying that if you're looking for alternate places to put money outside of equities, which I don't think are a good place right now, or corporate debt, which especially high yield debt has a lot of price risk in it, then things like bullion, may indeed fare better than those things.
Are we likely to see the inventory of homes for sale pick up after Labor Day?
Well, again, tracking the amount of people that have the amount of debt that's coming up for renewal. Like I know a lot of corporations and private equity, private debt, these funds and so-called institutional investors or private investors, they're doing a lot of handing back keys and walking away, defaulting and saying, no bueno, we can't pay, we're not paying. It's harder for individuals to do that. They have to go through an insolvency process or a reorganization process. They get into default. I have a couple of several good friends that are on the bench in Canada, and they have been telling me that they're signing a lot more writs foreclosure. That volume is definitely picking up, and they say it is not just from the alternative lenders, but indeed the banks are now starting to move on people who are falling behind on their mortgages. So just watching all those trends and knowing that, there's a huge supply of housing in Canada that's over the $1 million mark. The average home still is around $720,000. It's even hard to qualify for that kind of a price point. If you were making, I've mentioned this before, but people should really look at mortgage calculators. If you're making $200,000 a year as a household income, which most aren't, and you have no other debt, you can afford to borrow about $690,000 today, maximum top of the allocation or approval for mortgages. So that gives you a sense of where the purchasing power ability of the population, of the masses, is. And so you keep that in context when you look at these properties that are listed all over for $1 million, $2 million, $2.5 million, and you know that those people, as we know, most of them have mortgages, right? I just went through that data at the start. It's a very low percentage of people that have their house paid for. So when you look at all that together, you realize that there must be more properties coming to market as these mortgage terms approach and are needing to be renewed. And I'm certainly starting to see more for sale signs coming on the market just in the past few weeks around me in the north of the Greater Toronto area. And again, they tend to be in these more expensive homes. Some of them have been sitting on the market for already more than a year, and I'm watching the prices come down. Some of them have come off, 20, 30% already. So I think that that's what we are likely to see. It's got to clear some way, right? There's only a couple of ways to clear this market, and sales and reallocating capital from those who took on too much in debt, who no longer can service that and need to either sell to pay down the debt and or hand it back to the lenders. And all of those end up being typically brought back on the market for sale. So I know we've had low inventory, and it depends on the area and the price point of the property, but I certainly think that we should expect to pick up in the inventory of listings.
Are tighter credit, higher interest rates, and increasing inventory a recipe for a housing crash?
Well, again, it depends on what you consider a crash. A normal historical outcome following the level of extremity we had in valuations and debt abuse would typically has resulted in a 25% decline in property prices nationally and prices thereafter to stay flat for about a decade. That is the very typical outcome. That's what we saw after the 1981, big mortgage rates went high and people had a lot of debt and they'd been speculating in real estate, and you saw the prices come down significantly, lots of foreclosures, the whole savings and loan debacle, all that happened, and then prices basically stayed stagnant until you got to the late 80s. Then we had a sort of an echo version of that where things boomed again very shortly for a couple of years, and then again crashed and prices dropped very precipitously, 25 easily, in many areas more than that, in a matter of months. And then didn't revive, as I was saying. In Canada, pricing was really pretty flat in most places all the way into the mid-2000s when the U.S. housing bubble was really flourishing in America and really left Canada out of it. So that would all be kind of typical, and that's what I'm thinking is likely.
Could Canada's housing market become a market for cash buyers?
Well, it's always a market for cash buyers. If you have the cash and you want a place and it's within your means to buy it or your interest, you can go ahead and do that. But as I said, just 30% of Canadian households are debt-free today, and not all of them are going to be looking to buy or add to their real estate holdings in the next little while. Indeed, some may decide that they'd like to downsize their expenses or their overhead in terms of their real estate holdings, even if they don't have a mortgage, right? If you're having to pay out to carry a property, not even without a mortgage, just because property taxes are going up, utilities, upkeep, maintenance, there's a lot of people that, have taken on additional properties in the past few years when that seemed to be the thing to do. And now, just as you age, you look to simplify your life and downsize things. So I think cash buyers will always have a role to play. The question is, at what price? And that remains to be seen, and it'll be different for the, property specific and area specific to some degree. But en masse, I think the cheaper housing gets, the longer prices are down, the more likely you're going to attract buyers that have money and a specific purpose in mind, or the landlords that know what they're doing, right? Landlords who can buy and look at the returns or the rents and say, this is actually a great cap rate, this makes sense. I mean, that was all thrown out the window in the past few years where people were doing no math, it was negative carry, and they were just buying because they could get cheap credit. So I think we're in for a period where the opposite will be the new theme.
Could Prime Minister Trudeau's open-door immigration policies prevent a housing crash from happening?
Well, I mean, as I mentioned, just 72% of new immigrants are renters, and that typically lasts for about the first 7 years. The data shows that it takes about 7 years for a new immigrant to get their feet under them enough and to, save up and to get working and all those good things to, accumulate enough ability to purchase a home. So I think that we shouldn't expect that new immigrants are going to, buy up all the real estate. If you look at the just 29% of foreign buyers in the latest data in Canada were doing it as a primary residence, and 49% were buying as a vacation home. That was sort of last year. So there was definitely some foreign buyers, not necessarily immigrants, who were purchasing properties in Canada as a land bank or as a notion that it was a good investment, not really with a profit, not with a rental focus, but more like we'll just put some capital there and it'll go up in price. Well, if you get to a point where, don't forget that this is global what's happening, right? So China's in a major downturn, disinflation, the same credit bubble's bursting there, the housing market is in disarray, you're getting the largest property developers starting to default on all kinds of loans and debt bonds that they borrowed from investors. So all that is happening all over the world. So I think it would be pretty strange or naive to expect that, foreign buyers are just going to insatiably gobble up our real estate no matter what's happening all over the world or no matter whether our prices are falling. Because at the beginning stages of that, they don't want to be catching a falling knife. Now, at some point, if the prices get attractive enough, you will definitely, attract, as I say, buyers, whether they're domestic or international. And so I think that is the upside, or that will be good. That'll be an equalizer that will come into the market at some point, at some price. But as far as the rental market goes, I think the immigration issue is a big problem because of the fact that most need to rent, and we don't have enough of the affordable renting available. Now, part of that will correct as prices come down, and that's multi-apartment units as well. There's a good supply of that now in the pipeline being built, coming to market, and I think that we'll see price pressure to the downside there as well.
Do you think Canada's in the early stages of recession now?
Yeah, I mean, the problem with that is, of course, it's always a formal declaration in retrospect several quarters after the fact, right? So we never get the formal declaration, if by the time you hear it's a recession, it'll be too late, and most of the financial damage is well done by then. By the time people are saying it's a recession, that's typically near about the time that the stock market starts to bottom and things start to get more attractive on an investment basis. But as far as job losses go, you tend to see those continue even past the end of a recession because unemployment's a lagging indicator. So you will see that unemployment will continue to rise and look worse even after we're bottoming out in the economic cycle. The same thing with consumer spending and discretionary items and all that sort of thing. That spending typically goes on, well into the recession. So none of those things, just because people continue to spend, even though they're doing it on a lot of credit, which makes the matter worse later on, because they're continuing to spend, because we have unemployment, none of that means we're not heading into recession. So we have to look at all these other leading indicators, which we do and track, and I write and talk about them all the time. And those things suggest not just the inverted yield curve, not just all the employment data like the decline in hours worked and the decline in temporary jobs and the decline in full-time jobs. All these are leading indicators of the employment market. And all of that is suggesting that we're either in already or entering any time now a recession. And as I say, I think it's probably global, certainly in the world's largest economies, certainly in China, certainly in the United States. The UK is in a very similar pickle. The Eurozone is also in a very similar straits. Germany's in a recession already. It's had 3 quarters of negative industrial output. So I think we should be expecting that this is all connected, and we're in for a give back period from the overspending that went on during the pandemic.
What investments are you buying right now?
So, we're absolute return. We try and pick things that will hold stable value, pay us a good income, and not risk the principal significantly. So we will be buying equities, and we really look forward to that. As dividend yields come up with the prices going down, you start to get to a point where they're very attractive. You need to have cash set aside for those purchases, though, because you don't want to be selling assets that have fallen in order to buy things. So that means you have to have a good amount of money set aside in whether it's short-term deposits or money market funds, which are yielding around 5% today. So that's a nice place to park. We also have government bond holdings of all different stripes, whether it's municipal, provincial, and all different durations. Those tend to rise in value as we go into recession and the equity and corporate debt stuff starts to fall. So it's really a function of just trying to be places where you can get some yield, where your principal is protected, whether you retain liquidity, and that you have a plan for how to execute as the bottom presents. And that's really a lot of work. It really is. People think that if you're not buying, that you're maybe asleep or not doing something. Actually, it takes more work to know what not to buy and when not to buy it sometimes than it does to know, to buy things. So it's a constant effort of keeping your focus on the numbers and on not falling in love with the madness of crowds, and to keep your wits about you. So that's all the context and goals that we have to focus on at this point.
Where can people follow you?
So I write the blog daily, have done for over 16 years, jugglingdynamite.com, and I put all kinds of links on there to articles and commentary that I write and that of others, and videos I think are relevant, all to try and keep the public aware of where we are in the cycle and the things to be paying attention to as an antidote or a counterbalance to the perpetually bullish sell side that they get pounded with every day on mainstream media and through their typical advisory groups. So, yeah, mostly I would suggest jugglingdynamite.com. Our firm website is venablepark.com.
Danielle, thank you so much for being on This Week in Money.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Coming up, Mark Leibovit, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money, Mark.
Glad to be here. Thanks for having me.
Mark, can you tell us if there's going to be a special offer for our listeners this week?
Yeah, let's do it. I always appreciate the show, and I'm grateful for those who want to sign up. It's a 50% offer at vrtrader.com for any of our newsletters. And the promo code, when you get to the newsletter you want, you enter the promo code 2022, half off, just as it sounds, 2022 HALFOFF, and you get 50% off for any time frame that you specify. So that's where you go. And I also want to mention, since we're talking about the newsletter, my business, I am a newsletter publisher, but I am not a financial advisor officially, nor do I provide financial advice.
Mark, could you maybe tell us what VR stands for in VR Trader?
Well, it goes way back to my technical indicator, which I use for the most part for trading purposes and general trend analysis. It's called volume reversal. It's actually trademarked. And the original newsletter back in 1979 when we launched it, shows you that we are dating ourselves here at 44 years, but it was called the Volume Reversal Survey. And what we basically look is screen all the stocks that we had some interest in and look for these change of volumes and price pattern in the stocks as a trigger for buying or selling. And I developed that a lot when I was a floor trader back on the old, it's still there, the Chicago Board Options Exchange as a trader, just watching the volume flows. So we look for volume coming off bottoms to the upside and volume coming off tops to the downside as, trading indicators. And we just saw that, for example, in Apple Computer just the last week or so when it came off that top. Of course, there was an earnings announcement as well. And the street didn't like it, but volume came in and it's been trending down since. So that technical signal along with the news was, part and parcel to the analysis we do.
August 16th, we'll have a new moon. Do new moons tend to affect markets?
Well, all moons are worth watching. I've told the story 50 times, and I always tell it because we don't know who has not been listening. But I got started this back in 1974 when I watched the Louis Rukeyser Wall Street Week television program, which later, by the way, I ended up joining as a elf when Louis called me many years later, and Ian McAvity, who is a technical analyst in Canada out of Toronto, I believe, produced a newsletter called Deliberations, and I got to meet him in years subsequent and became friends. He passed away in recent years, but he on that show, they never had him back again, he talked about the full moon and gold being coincident with each other. And, of course, everybody's ears stood up, and even for me it was, new at the time, and it turned out, I ended up being affected by that to a great degree because I started charting the moons, not only against gold, but the other markets, because I respected him as an analyst, and I found out over the years there are correlations, and nothing is 100%, and it could be the quarter cycles as well as the full moons and the new moons, but it's applicable to all markets, commodities, stocks, currencies, you name it, and you chart them. It's like anything else, and if you're rallying into a lunar cycle, you tend to be coincident with a top, and if you're selling off into a lunar cycle, it tends to be coincident with a bottom. He felt at the time that you would have highs in gold, relative to the full moon. Turned out that wasn't the case because it could happen either way, but the moons become like change of direction points. So that's sort of my history about the moon, and I relied on a great analyst decades ago that triggered me to look at something which nobody had ever mentioned as possible, though I had heard years later that a lot of commodity traders always look at the lunar cycles because of crops and all kinds of other things. So it wasn't new to commodity traders, but for me it was, and I still look at it. So to answer your question, I don't know what the new moon will be. We're selling off here a bit, so maybe we'll hit a trading low just around the lunar cycle. So that's the best answer, and we just have to watch the tape action at the same time.
Is the Fed likely to continue raising interest rates?
Well, they sure say they are, and all the evidence now, we have this geocosmic event out in Hawaii with Maui burning up, and I just saw a report on CNBC about how insurance companies will probably now have to raise their insurance rates, and that's going to contribute to inflation. And we have a lot of other triggers out there showing our inflationary pressure still out there, and Fed's using this as an excuse. I don't think they're going to be successful just raising the rates. In fact, raising rates actually creates more inflation, in my opinion. So the way that they could curb inflation, and it's starting to happen a little bit now, is by banks cutting back on lending or making it more restrictive to lend money and making it tougher to lend money, and that'll slow the economy down more than just raising rates. So it's starting to happen now, and if it accelerates, the official media is discounting the recession. Oh, it's not happening, or it's going to be a soft landing. There's no question we are technically already in a recession, and it will get worse if the banks continue to follow this policy. And people thinking that it's related to just the Fed raising rates, it could be a psychological negative as well. So, they're going to be doing it, and everybody's hoping for them to reverse position. But history actually says, and nothing is perfect here in my comment, but history says that when the Fed actually starts to lower rates, there'll probably be some significant event that would have triggered them to do this, which means the market would have crashed, or there could be an outlier event of some kind. It could be war, or it could be, more geocosmic events, more storms, hurricanes, asteroid, God knows what, but they would have to lower rates as a response to some event, not because they say, oh, we feel sorry for you guys and we're going to taper off here. So history generally says that they're doing that, and the street is hoping for that moment that they reverse rates back to the downside. They may eat their words, because that could be the trigger, or we could be in the process of a more significant negative economic and stock market event. So it's really crazy what you hear on TV or what you hear in the press, and where the truth really lies about this stuff, and they really don't talk about it. Of course, where I stand on the Federal Reserve and the Treasury, and as far as I'm concerned, Fed needs to be abolished because they've screwed up so much. But it's not just the Fed, it's so many other factors out there, and we're not going to change the system because we're unhappy with it here. But it's the only offset I could say. Jim, I know you're asking about the rates, is we do have a presidential election next year, and we do have the plunge protection team out there trying to support the market on occasion. So we'll just have to follow the cycles here. We have the presidential cycle low, a 4-year cycle due anywhere between the fourth quarter of this year and the first quarter of next year. And we'll have to monitor that and see how that ties in with what the Fed's doing and with, other outlier events may unfold. I keep talking about outlier events, and then out of the blue, it was about a week ago, Fitch lowers the rating on U.S. debt, and that's a significant event, though. Janet Yellen tried to downplay it, the U.S. Secretary of Treasury, but that was an outlier event that came from left field, that they just came out and downgraded the debt. Well, that's a serious event because it makes it more difficult for foreign activity, and it's just a mess. So that sort of drives rates up in and of itself, which is additional cost for the U.S. government and their Treasury offerings and so forth. So there could be other events like that could come supposedly as a surprise. And it's funny because you and I had been talking about this. We were hitting a top in July, and sure enough, Fitch comes out and hits us with a news story.
Our sympathies for the people of Maui. We call it here in British Columbia the 11th, unofficial 11th Canadian province, because so many of us holiday there and have condos as well. So,
wow. Yeah.
Are you bullish or bearish on the U.S. stock markets?
I am bearish right now. I think overall, with the floods protection team and with the election next year, and all these positive anticipations regarding what the Fed may or may not do, there could be more of a rally coming. We'll have to look at the correction. We're in the cyclical negative period. Just about everybody knows about it. Between now and October or November, we run into this negative time of the year. Nothing that necessarily goes straight down unless there's a 9/11 type event or something dramatic that really crashes the market. But for the time being, and then I'm open-minded to, exploding back to the upside because of the election and manipulation of the markets and whatever. So, you got to watch the charts, and that's why, I don't trade that way. I'm not acting on that view right now. We're short couple indexes here because we think the market's going down, but at the same time we're long crude oil and crude oil related stocks because oil has been doing well. So we sort of play what we see on the charts, and that's the best strategy. But overall I would say cautious for now, and let's watch it here until the fall.
The U.S. dollar still seems to be trading in a range. Is this trading range likely to continue?
The U.S. dollar is really frustrating for the precious metal bulls out there, because the thing is just it doesn't want to give it up, and it's been rallying here, and it's been putting pressure on gold. I'm sure we're going to come to that subject in a moment, but basically, we had a nice sell-off. Gold was doing a little bit better, and gold and basically a dollar, that is, sold off into mid-July, and ever since then it's been rallying, including today. Friday, as we're making this recording, and it's reaching toward the top, that little trading top it made back in the end of May, and it may, if it takes that out, then there could be an acceleration here, which is bad for commodity prices since they're priced in U.S. dollars, and it's an inverse relationship. Same token, crude oil has ignored this. This is really interesting for those who like to draw that inverse relationship between the dollar and commodities, where now we've got crude oil strong, still looking overall positive. Of course, I'm a big picture bull, looking for $200 a barrel, and whether it's months or years, but it's coming, and a lot of it is related to short-sightedness regarding political policy and so forth. But also, here we have crude oil rallying along with the dollar. So that's sort of driving some traders nuts, but the trend in the dollar still seems to be up at the moment, and we'll see if it continues. And crude oil overall, still looks higher. And you didn't ask me that question, but they're sort of tied here to the traders' thinking. So at the moment we're giving the upside dollar the benefit of the doubt, which is not good for the precious metals. If the dollar could reverse, then that would be a plus for the metals.
Gold seems to be also stuck in a trading range. Is gold likely to remain in a trading range?
Well, what kind of trading range we're talking about? The trading range I'm really looking at is between 1,600 and 2,000, which is a 400-point trading range. That's been really was defined gold here in the last several years. So, if you're willing to trade within that range, yes, that's a trading range. Right now, I'm more concerned for the bulls out there, because this 1,900 area is support in gold. Of course, I'm talking relative in U.S. dollars. And then if 1,900 doesn't hold, then we're looking around 1,850 as the next support level, and risk all the way down to 1,600 if there's a crash type environment in gold. So for now, let's see where the dollar goes. I'm more optimistic on the dollar, I think, in terms of its continued rally, but I'm also optimistic on gold. So it'd be nice to see the dollar come down because that would give fuel to the gold, but it may not happen. So right now, if you're a trader, you're waiting for a confirmation of a bottom in gold, and whether it's going to be just above or around this 1900 level or in mid 1800s, we'll have to see. And I guess you're also hoping the dollar reverses and doesn't continue this uptrend, because that would certainly help your position. And along those lines, silver is, on traders' minds, and that $22 level is sort of important for traders. But if it really breaks, you got $18 as the next big support level, well below the market, and that would probably happen only if the dollar continued much, much higher. So right now they're in a correction. I'm hoping for a reversal. It hasn't happened yet. This is a trading comment, and then we'll just have to see what unfolds here. So, but you have your finger on the buy button, but you're for the gold and silver. If you're a trader, if you're an investor, you're in anyway. And my comment is irrelevant, but you have your finger on the buy button once we get a signal of a trading bottom here, and it might tie in with a little trading top in the dollar, and let's see what happens.
China has been buying gold like crazy the last few months. Any idea why?
Oh, because they want to displace the U.S. dollar as the world's currency. You've got the BRICS meeting coming up in, I think it's August 22nd. There all is discussion about them trying to create the new currency and backing it with gold, but the most recent reports that I've read is they're not going to address the gold-backed currency issue at this time. There's a worldwide conspiracy out there to get rid of the dollar and replace it with another currency, and Russia and Brazil, and, are all behind that. So, China as well. So that's one of the reasons you've got China buying gold. Russia have been buying gold. They're all, and for good reason. 5,000 years, gold's been the standard. It's always there. No matter how it's not officially talked about or poo-pooed, governments around the world have been accumulating gold and do a lot of gold leasing and exchanging and all kinds of shenanigans for the longest time. And it's a big part of what governments believe is their stability, is having gold in their vaults. And, a lot of countries, I think just recently was Poland or Czechoslovakia, one of the Central European countries, was adding aggressively to their gold holdings. So all this happens for a reason, and it's because over time currencies tend to devalue because of government spending programs. You look at the British pound, how much it's come down. Other currencies have disappeared. U.S. dollar has lost its value since the Federal Reserve came in. It lost about 97 or 98% of its value. So, where do people go? They look for hedges, and gold is one of them. Of course, real estate has also done well because it's a physical asset, and other commodities as well. So, and this is another reason why cryptocurrencies became hot, and Bitcoin had a run, and is still a viable alternative because of fear of the currencies, disappearing. So, to answer your question, yes, gold is important, will remain important. Governments secretly continue to buy it. They don't talk about it, and ultimately that's going to be the longest-term store of value.
With all the governments pushing for a digital currency, do you think there would ever be just one worldwide currency and then the currency market disappears?
I can't even speculate on that. I know that there's a lot of pride in each country, and even the euro, even though a lot of the European countries didn't like the fact the euro had been created, there's still pride in having your own currency for your own country. And I don't think this is what the World Economic Forum, Klaus Schwab and all those that are out there talking about, you don't own anything and you're going to be happy. That's the Agenda 2030 that Klaus Schwab and that group's been talking about. I'm sure they'd love to see, one digital currency and no other currencies in the world. Why? Because they can control you. They can follow what you're doing. They can prevent you from buying and selling certain items because it's electronically monitored. They can punish you and close down your account, and you won't have any money. It'll be the ultimate authoritarian control to have, a worldwide digital currency, and I'm sure that's the dream of the World Economic Forum. I don't think it's going to happen. But there's a lot of people that are concerned about it, and from what I read, there's about 100 banks testing some type of digital currency right now. And what people don't realize, the problem is the younger people are less aggravated about it than the older people like me, that have been doing this forever. They're so electronically oriented, internet oriented, trading crypto and all this other stuff. Probably if their bank account got converted to a digital currency, they probably wouldn't be as irate as someone like myself. And others who are older who understand the risks of what that really means, the control factor that I just mentioned, that they could monitor you and close your account down and stop you from doing things, and that's what the government wants. And it seems like the younger people that are, more into the electronic world seem to be less concerned about it. That's sort of my reading about it. So it might happen, much to my dismay and others of my age group, but I think if it does happen, it would be they'd be giving up a lot of freedom and control of your life, and I'm not really happy about it. I enjoy the idea of having an alternate currency, like a Bitcoin or an Ethereum or an XRP or something else that you can diversify, but having you forced to have all your currency in a government-controlled, as they call it, CBDC, is not something I'm happy about.
Also, with part of Agenda 2030 is the idea to string people out on debt to ensure they owe nothing and have to be supported by government handouts.
Yeah, you could go all kinds of quote-unquote conspiracy theories about what they're planning, and I've heard that, and whether that has any seed of truth to it. Basically, the left, if you want to call it, or the socialist movement, or the green movement, they all seem to be in cahoots in the World Economic Forum, and they all want to centralize control and take away our freedoms. So what you're saying could be very much a possibility. I hope I'm not around when that happens.
Well, just to give an example of what happens, the trucker protests, people who thought, these people have a legitimate beef about vaccines, contributed $25-50 to the truckers and ended up getting their bank accounts frozen for months just because they disagreed with the current government policy. If you have a digital currency, the second you say, I don't like that particular government policy, are they going to freeze your bank account?
Right. They say they won't, but they have the power to do it.
But they've already done it.
Right. So, the question is, will they do it here as Trudeau did in your country? And, the answer is yes. They're looking to control. So it's very tough situation, in terms of our freedoms and where our countries are going and who's going to be in control, and and these outlandish expectations on the Agenda 2030. Not you won't own anything and be happy. It doesn't work. People want to own things. They want to have a legacy for their children. I know in my own, culture in Judaism, there were kibbutzes in Israel, which are basically communist little enclaves, and most of them disappeared. And I went to visit one in maybe about 10 years ago in Israel, and what I heard was, those who contributed everything they had to make the kibbutz work. It became a socialistic, environment where everybody shared everything. But when the owners died, they had nothing to leave to their kids. And that really bothered them. And they really want to have a legacy for their children. And so the contributions to that type of environment disappeared, and the kibbutz essentially failed, which was, I guess you can say is a Karl Marx attempt, socialism, communism, and it failed. And there may be one or two left in Israel, but, they're not doing what the original agenda was. So I think, the history teaches us something here. People want to own something. Klaus Schwab won't be successful. He wants to own everything and control it and tell you what to do. I'm sure China, I can't believe, unless China controls everything, I'm sure they don't want to join this Agenda 2030. They may show up there, but they want to control everything. They don't want to be sharing it with anybody else. They're trying to take over the world right now anyway, as you know, from buying land here in the U.S. to controlling parts of Africa and all the technology, stuff going on with them. Just a lot of And then, they want to land, they want to have a big operation on the moon, a big moon base to monitor the Earth and so forth. So I don't know how Klaus Schwab's going to manage in this environment when others in China, I know Putin in Russia, he wants to remain independent. He's an independent cuss, which I admire him for on a certain level. So, there's going to be a lot of static in making this work. So I'm not too optimistic for their success.
Are people waking up to the evil of central bank digital currencies?
Well, I touched on this a little bit earlier. Yeah. Basically, I think the younger group is less concerned about it than the old folks like me, the older generation that, seen the evolution of government encroachment in our freedoms and so forth. So the younger group are so, as I mentioned earlier, so digitally and internet connected, and they're brainwashed on a certain level by the socialistic movement. I think they're less concerned if the government issues a digital currency and their bank account turns into a digital currency overnight. They may not really recognize yet, though they will ultimately, that they've given up freedoms by accepting it. So it is I don't know if they've woke up to that evil yet, but it will come if the currency imposition, digital currency imposition, takes effect.
And the underworld's already aware of digital money tracking. Apparently, they're using Pokemon cards as a form of currency because there's no cash limit on Pokemon trades. Whereas if you take cash across the border, if it's 10 grand or more, you have to report it to the government.
That's a good point. I didn't know that.
Yeah.
Okay.
So people are already working to get around possible digital currencies. Is there a push for 15-minute /smart cities in the U.S.?
I did a little work on this. I heard that we were going to be asked this question, and there really isn't. There's a few of these things going around, but they really it's being misinterpreted because some people feel that the idea of the smart city was more government control over your life and so forth and so on, and others are arguing no, the whole idea was to keep all your shopping and services close by to you so you don't have to travel as much. There's differing views on it. There apparently is some movement and talk about the 15-minute smart city. It could be 15 minutes bicycling, driving. It doesn't have to be, just walking. It's sort of loose in the way it's being defined. But, having everything close, I guess, ought to make sense. You don't have to travel far for all your, medical and grocery needs and so forth. It may be happening despite this push. A lot of communities are sort of small in their own way. I mean, in your community, I'm sure it's the same thing. Usually everything you need, that's why you live where you live, because things are relatively close to you, and you have all the shopping and other needs that make life, more comfortable. So I think it's happening despite this, but there seems to be a bit of push. But the people that are against it are saying, no, it's government control encroaching on our lives, forcing us to, live in these more contained areas. So who knows? I really don't have much of an opinion. I'm just sort of reading the news.
The Trudeau government's environment minister says by 2035, gasoline-powered vehicles will just be outright banned. And our deputy prime minister, finance minister said, well, in Toronto, wherever I go, I just take the subway. But she made this speech in Prince Edward Island where I don't even think they have a divided highway. It's such a tiny place. And outside of Canada's 3 big cities and maybe Calgary, Edmonton have light rail. Winnipeg doesn't, which is a big city. You're really dependent on your car. Once you're outside of the major metropolitan areas.
In 2035, these guys won't be around anymore, and the whole movement, about converting everything to EVs is going to blow up on them. I think they've already said that the sales are way down. People don't want the cars. They want it for the obvious reasons. They can't charge them. There's no place to charge. They're very expensive to charge, and on a bigger picture basis, there aren't enough charging stations around, enough electrical infrastructure to support them. And so the tide's already turning. Ford apparently just lost a bunch of money on the EV project. So the economics will dictate this, the supply chain in terms of getting the power to power these and also getting all the materials to create them. I mean, we got China controlling many of the rare metals out there. I think about 70 or 80% of the world rare metals are controlled by China. All the ingredients that are needed to create these vehicles are not so easily accessible or affordable. There's so many variables here. I hope they come up with a solar-powered car or a fusion engine for your car or some other alternative energy rather than plugging into a plug somewhere, which really requires broad expansion of the nuclear energy system around this country and your country and the world to create the electricity that's needed. So I'm in the Back to the Future camp, where Doc opened up the front hood of the car and opened up a fusion engine and threw a banana in there, and that was enough to create the fuel needed to power that fusion engine. We need probably some type of solution like that, which may already exist because we don't know all the technology that's being tested or being used secretly, but that's really the solution to car travel, or maybe you can put up solar panels on the top of the car that charges it. We don't have to fuel anywhere and save both gas or electrical, power. So I'm not that optimistic. It's sort of a fad. Tesla's done well. People like it. I dislike it because I can't hit the road and drive, indefinitely. I get, on an EV engine, I have to stop constantly. At least, hopefully, for the time being, gas is still available where you're driving. So, some people, I think, are realizing this, and I think, Tesla had to cut prices on some of their their automobiles. It's driving their stock down. It's a long-term conversion, and whether it ultimately will happen or not is questionable in my mind at this moment. It's a political tool, and some people making money on the stocks and on the concept, but whether it'll be accepted by the world's population and whether it really can be based on the fuel aspect of it, time will tell. I'm not that optimistic. I recently purchased a hybrid car which uses gas and a little charge in it, so I want to cover my bases.
And Joseph Schachter, friend of the show, who puts out the Schachter Energy Report, said, well, Europe, China, North America pushing for electric cars. In Africa and most of Asia, just finding gasoline is hard enough. They barely have enough electricity to keep the street light on at night.
Well, so say hello to Joseph. He's a good friend. That's a great insight. And I think he and I are both in the same camp that crude oil is going a lot higher down the road. So, you had a source of energy for, decades and decades, and suddenly they pull the rug from you and say it's not around. Meanwhile, the world economy is based on it. So crude oil is not going anywhere so fast.
Also here in British Columbia, we rely on hydroelectricity, but we're in a major drought. We've got major forest fires burning out of control. Will we, in 40 years, be getting enough snow and rainfall to power us if we use hydro dams?
That's a good question, of course. If that could affect here in the Southwest, here in the U.S. with Hoover Dam and Lake Mead's levels.
Right, you're already going through it.
Right. So, they're already seeing that. Of course, right here in Phoenix, right side of Phoenix, we have the Verde nuclear power plant, which is actually the largest in the U.S., and it's about 20 miles out of town as you drive west to L.A. on Interstate 10. And as long as that thing is operating, we're in good shape here in Phoenix in terms of electric power. So, we're way ahead of stuff on a certain level. And there's that new one opening in Georgia and here in the U.S. Maybe the tide is turned, but we need that anyway. Whether we have a demand for electric vehicles or not, we need other sources for our energy and nuclear. They're more safer, nuclear plants now. And, we know the military operates nuclear-powered subs and battleships, and they could stay on the high seas forever with that type of energy. And we know satellites are using it, so we know it's all possible. So I think the real answer is nuclear. And space travel, I think, is going to be part of that process, too.
On the geocosmic front, the Perseid meteor shower is happening this weekend.
It sure is. It's August 12th through 13th, and it's from the comet 109P Swift-Tuttle. I don't know if you knew that. It causes dozens of meteors per hour to streak out of the constellation Perseus if you look in that direction. And it'll make it the new moon, which, obviously makes a dark sky. It makes the display more easy to see here. So we're lucky we've got the new moon. We talked about that earlier in the interview at the same time of the Perseus event. And also we have, I'd like to give you a quick solar cycle update here, which is sort of interesting since you asked about the geocosmic. We have, we're in this coming to a peaking area, and it's a rising area of this 21-year cycle and sunspot activity. And it's being highlighted on spaceweather.com as an important point here that we've seen an increase in sunspot activity, and this generally leads to more solar flare type activity. So basically, they're thinking there's a stronger surge now for solar flares as a result of this increase in the sunspot cycle that we're in now. So apparently there was a big peak back around 2002, and it's been 21 years, and we're coming into this point now where we're in a rising, peaking time frame, which could last a couple years. So more risk of solar flares, and that old Carrington event possibly on the horizon repeating itself. And so, there's a lot of attention. You don't hear about it in the media too much, but a lot of scientific attention about what's going on in the sun and how that activity could affect our planet and our weather. So nothing we could do about it, like, a sudden meteor or asteroid blasting through the sky, and we see these occasional outlier events, but it's something that we should be, certainly aware of. Of course, if we get one of those, super solar flares, that will affect our lives because it could blow out a lot of technology here on Earth. So it's worth just watching it. Again, we can't do anything about it. You could try to prepare on a certain level by having alternate energy sources in case you really think all your power is going to go out. But, the sun will always be there. I guess having a lot of solar power as backups in case everything else goes down, but the internet will probably go down if there's a super flare. So always I joked about it just to myself and maybe to others, if you really want to win a war on this world, you just have to cut all the internet down, shut down internet everywhere on the planet, and that would probably do more damage than, rockets or atomic bombs in terms of accomplishing your objectives. So, meanwhile, a super solar flare could help accomplish that, unfortunately, without any man-made involvement. So it's just something fun to watch, and I always track it just out of curiosity.
Mark, thank you so much for being on This Week in Money, and how can people find out more about your special offer?
Yes, please go to vrtrader.com, where we, by the way, cover a lot of this other stuff, the geocosmic. We write articles and stuff related to it, so those have some interest in the cycles and so forth, including the seasonal cycles. It's at vrtrader.com, and the promo code is for 50% off 2022, half off. Thank you for asking.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was speaking to us from Arizona. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Danielle Park, and Mark Leibovit. And thank you for listening. If you have any questions for our guests or the show, you can send your questions to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.